This is the FM Gold channel of All India Radio. In the program News Analysis, now we bring you a discussion on rupee volatility. The participants are Paranjay Guha Thakurta, economist, and Urmi Goswami, senior journalist.
The rupee has been in a free fall. Today is, I think, around 67. And there's been a lot of concern that's expressed about the rupee's free fall and, of course, the impact on the economy. Why is the rupee in such a state? I know there are some external factors, but what are the internal factors that have contributed to this?
Let's look at both sides to the story. Let's look at the external factors as well as the internal factors that have resulted in the rupee losing its value vis-a-vis the American dollar by roughly about a fifth over the last 6 weeks or thereabouts. And if you look at the whole year, then it's probably about a quarter it's lost its value. This has taken a lot of people by surprise, and very few people were expecting such a sudden and a sharp fall in the rupee. So let's look at the external factors. The external factor is, yes, the ongoing international economic recession, the Great Recession, is continuing. Europe is going through a double-dip recession. After the head of the US Federal Reserve, Ben Bernanke, made a statement suggesting that the quantitative easing, which is basically a way of pumping in liquidity and money into the system by the US government buying bonds, that program would slow down in the foreseeable future. It kind of sent shock waves across the globe. And the currencies of many developing countries, including Brazil, Turkey, South Africa, Indonesia, and of course India, have all come down fairly substantially. But the question remains as to why the Indian currency has come down more than the Brazilian currency or the rand or the Indonesian rupiah or the Turkish currency. Before I come to that, let's look at another international factor which is adding to the uncertainty, and that's the price of oil. In the wake of the very turbulent political situation currently prevailing in Syria and the fears that there's going to be military intervention by the United States of America and the Western countries, and the apprehension that this would result in oil prices shooting up perhaps well over $120 a barrel. Time alone will tell whether that happens or not, how the Syrian situation plays itself out. All of these have a direct impact on the Indian economy. The principal reason for the devaluation of the Indian rupee is our high current account deficit. This is a problem that's been taking place over the years. In a particular quarter, it crossed 5% of our GDP, and despite the government's best efforts, it's going to be a very difficult job to keep the current account deficit under control. What is the current account deficit? The current account deficit on the external balance of payments is an indication of the difference between the inflows and the outflows of foreign currency. The main reason why the current account deficit has gone up is because your trade deficit has gone up. The trade deficit is essentially the difference between the value of imports and the value of exports. Now, let's look at exports. India's exports are sluggish because many of India's traditional exports are to countries which are going through a recession, notably Western Europe. So if among India's major exports are polished diamonds, gems and jewellery, handicrafts, textiles, clothing, processed foods and so on and so forth, leather items, many of these products are today, their markets have shrunk or disappeared, and the markets in the East are yet to really revive or pick up. The other problem is you would expect that when the Indian currency devalues vis-a-vis the US dollar, it's good for Indian exporters. Yes, up to a point, but there are certain categories of exports like polished diamonds where we import the rough diamonds and polish them. So in such cases, to a great extent, the devaluation of the rupee gets neutralized and profit margins get squeezed. That's on the export front. Let's look at the import front. Now, the biggest single item of import for India, it's about close to 40% of our total import bill is crude oil. We are currently importing 80% of our total requirements of crude oil. Now, when the rupee devalues, there's a huge amount of pressure on the government and the oil companies because in rupee terms, the cost of oil imports has gone up. Now, the government has in recent times allowed these oil companies to increase the price of diesel. Now, what happens when prices of diesel go up? It gives a spur to inflation. Now, I'm going to tie this up with what's happening. Besides crude oil, what are the other items of import? We have been importing gold in large quantities. Recently, the government has tried to curb such imports by increasing the customs duties and placing other restrictions. But why were people importing gold? Because gold is perceived to be the best hedge against inflation. And we've seen very high inflation in the recent past. the high price rupee costs of imports of oil. That results in diesel prices going up. So we are importing inflation. When diesel prices going up, being a universal intermediate, it affects the prices of a wide range of articles of mass consumption, notably food. It has a cascading effect. Once that happens, in order to hedge against inflation, people invest in gold. And once you invest in gold, and now there's a lot of smuggling also taking place, that also increases the deficit. So you are in a classic kind of a vicious cycle. Investors are shying away. And the sad part of the story is over the last 2 years, for the first time in the history of India, India's own industrialists, India's own businessmen, India's own capitalists, yes, they want to be multinational, sure, but the outward flow of foreign direct investment has gone much above the inward flows of FDI. So here we have the government, the finance minister, traveling across the globe, exhorting foreign investors to come to this country.
But tell me this, one of the ways of addressing, as you pointed out, of addressing this current account deficit is, of course, create conditions within the country to improve investments. And in a sense, wouldn't the years of high growth, near 9% growth we had for 4 years, would have been a good time. It would also have been a great time to actually make those structural changes in the economic structures that we needed to make. The government let that go by, for reasons best known to it. Are we paying a price for not acting when we should have?
2008 is 5 years away. For the first time again in the history of this country, for 4 years in a row, your gross domestic product grew at nearly 9% for 4 years, continuously, consecutively. It's never happened before. But that great recession that took place after that, we thought we'd get out of that by spending. But what has today happened is it's not merely that we are paying the sins of the profligacy of the past. We have become excessively dependent on inflows by foreign institutional investors to bridge that current account
deficit. Which is hot money mostly.
Which is volatile, which is hot money, which goes back as quickly as it comes in. Now, you have here a situation where your stock markets, your own investors, 5 years ago, there were more people investing in India's stock markets than at present, or 10 years ago even. So, in a sense, your own investors have lost confidence in the stock market. So, the stock markets, the rise or the fall of the sensitive index has become totally dependent on the inflows or the purchase decisions, on the sale decisions of foreign institutional investors. Look at the sensitive index. We're struggling to cross the mark that was reached in January 2008, which was reached in October 2010. So when you have a situation where you become excessively dependent on these volatile flows of foreign currency, you have a problem on your hand. Now, a lot of people are making these adverse comments saying that the Indian economy is going through a phase which is reminiscent of what went through in 1991. What are the similarities? What are the differences? The differences are that in 1991, when Dr. Manmohan Singh became the finance minister in Mr. P.V. Narasimha Rao's government, India's foreign currency reserves were equal to barely a fortnight's imports. Today, our foreign currency reserves, they've come down from 300 billion to about 275 billion, but they're still more or less equivalent to 7 months' imports. Don't forget that our short-term debt is also high. It's about $170, $180 billion. So there is, reserves are adequate. What is the other difference? We've had 4.5 years of high inflation and driven by food inflation, double-digit food inflation. And this food inflation, what has it done? It's hit the bellies of the poor. It's not just pinched the pockets of the middle classes. It's like a double whammy. It's 2 kicks in the belly of the poor and the underprivileged. The same people you're trying to help today by the food security bill, by Narega, and so on and so forth.
Finance Minister P. Chidambaram, while replying in the Lok Sabha, sort of made a roster of 10 steps that we need to take or the government was taking. How effective do you think are the measures that he's talking about? I mean, those measures are sort of all over the place. They're talking about, they cleared 35 power-related projects, import duties on import of electronic items, and so on. So we are all over the place kind of measures. So what kind of impact do you really see?
Regretfully, I do not see anything new in the agenda. Yes, of course, you need to clear projects. We need to sort of do something about our infrastructure. But a mere cabinet clearance does not necessarily mean that these projects are going to take off very fast. I want to make 2 or 3 other points in this context. Yes, we need to increase our exports. Yes, we need to curb our imports. But none of these are going to happen in a hurry.
good years, we didn't make the investment in this country. I mean, actually, as you rightly pointed out, we are very dependent on imports. And it's not just imports, of course, crude. And the crude makes a huge part of our import bill. But
it's almost about 40% of our total import bill, yes.
And, of course, you imported gold to hedge against inflation. But in a sense, we have never responded trying to address domestic demand. We spoke earlier about how we are looking, our exports are not working out because the areas where the countries which import are, those markets are drying up. But what about harnessing domestic demand? We have not, have we made those kind of investments?
You know, a lot needs to be done and some very, very difficult decisions have to be taken. It's certainly, there's no doubt about the fact that we need to do something about spurring investment at home. Yes, one part of the story is to kickstart your infrastructure projects. That would automatically lead to a higher demand. We've seen the investment rate. We are seeing the savings rate slowing down over the last few years. If your Indian industry is not willing to invest in your own country and preferring to invest abroad, you have a problem in your hand. You can't really hope that foreign investors are going to bail you out. 9 months ago, you were willing to stake the future of your government on the whole issue of foreign direct investment in multi-brand retail. But the Walmarts of the world are still waiting for you to tweak the rules before they agree to come in. How do you restore domestic investor confidence? It's easier said than done. I think it's a very, very difficult period that the country is going through. It would have happened irrespective of whichever government was in power. But the problem has got compounded because the 16th general elections have to take place on April. The new government has to be put in place in the month of May 2014. You have major elections coming up in not just Delhi and Mizoram, but in Rajasthan, in Madhya Pradesh and Chhattisgarh, all happening around November. So, in this kind of a situation, you can't divorce politics from economics. And the government is saying, don't panic. Give us a chance. We are doing our best. The external environment is hostile. But look at it. I find it truly ironical that if there have been beneficiaries of the last 22 years of economic liberalization, it's been India's entrepreneurs, India's industrialists. The members of the Confederation of Indian Industry and the Federation of Indian Chambers of Commerce and Industry, so the CIIs and the FICCIs and the ASSOCHAMs of the world, their members have been the main beneficiaries of the policies of economic liberalization that have been followed for the last 2 years. Yet today, it's so ironical that they've been the loudest in complaining about policy paralysis. And I think a lot has to be done to revise investor confidence.
It's interesting that you raise the issue of industry and effective governance, because one theme that actually, that's like a subtext through it all, is everybody seems to blame environmental policies for contributing to this current situation. Former finance minister went so far ahead as to say 2.5% of the GDP. But of course the 2.5%, we haven't figured out how that 2.5% he arrived at it, but nonetheless, what is interesting is this just an excuse to have lax regulation for industry as we have had for years and years on?
Look, I think whether it's India or China, if these two economic powerhouses of the planet, of the globe, cannot industrialize, their economies cannot grow in an ecologically sustainable manner, in an environmentally sustainable manner, in this day and age of climate change, I'm sorry, then the future of planet Earth is very bleak. Let's look at some facts. The United States of America has less than 5% of the world's population. 300 million out of 7 billion, about 4% of the world's population. The GDP of the United States of America is still about a quarter of the world's GDP. $15 trillion out of $60 trillion. But India and China, which together account for 40% of the world's population, and currently on PPP terms, it's roughly about a fifth of world GDP. If these two countries cannot show the rest of the planet how to develop, how to industrialize in an environmentally and ecologically sustainable manner, then we go back to that old cliche. If every consumer or every citizen of India and China started consuming like the average citizen of the United States of America, then we would need 2 planets Earth, but we only have 1.
Thank you so much.
You were listening to a discussion on rupee volatility. The participants were Paranjoy Guha Thakurta, economist, and Urmi Goswami, senior journalist. It came to you in the program News Analysis, produced and presented by the News Services Division of All India Radio. This program is also available on our website newsonair.nic.in. You may email your opinion about this program at airnsttalks@gmail.com.